Hey friends, so let's talk a little bit about what lenders are looking for before they approve you for a mortgage. To make this easier, I have taken this content and divided it into an acronym that I call CIA. Now, CIA stands for credit, income, assets. And let's start with the credit portion. So, what's going to happen is anytime you go to a lender, let's say you're buying a primary home, and they're going to take all of these different categories, the CIA, and they're going to ask you for a few documents and run all of this through what they call DU. It's a desktop underwriter. For now, all you need to know is it's a government-backed software. And this software is going to look at your entire package and give the lender a thumbs up or thumbs down in terms of, okay, it's good to move on to the next step, or no, there are things that this borrower has that is not going to allow him to move on to the next step. So let's say you move on to that next step. Now, what the system plus the underwriter is going to do is they're going to look a little bit more in depth into your credit. That's the C. They're going to look at the past 24 months. They're going to look at any recent late payments. They want to understand anything that's unusual. And of course, they'll be asking you questions about those things. Then you move into I, which is the income. They're going to also look at your income, and depending on if you're on a W 2 or if you're self-employed, your requirements may vary. If you're on a W-2, things tend to be a little bit smoother. They're going to have some basic requirements, and then you move along. If you're on a self-employed, they may ask for some more documentation because self-employed, even though you can definitely get qualified for the bank, they see it a little bit riskier, so they just want to see some additional documentation. All right, let's move to the last one, which is A, stands for assets. This is how much money you're going to be putting down, where the money's coming from, any other accounts that you may have some cash in, such as retirement accounts. And so they're taking a look at all of this to determine what is the probability of you not paying this mortgage in the future. Remember, the banks are in the risk mitigation business and they need to protect their assets, right? So that's what they're going to be looking at, all these three. Now, here's a key that I always tell my clients that I'm helping with their credit restoration process. And it's as long as you actually start planning in advance. For me, at least 9, 12 months is key before you buy a house. Then you're going to be fine as long as you have a good loan officer. And that's the key. Always plan in advance. I'll see you in the next video. Ciao.